Good afternoon, everyone. This is Maria Blaise Costello, and I'd like to welcome you to today's webinar. We have a hard stop at 2 o'clock today on this event, so I'm going to just get right into it so that we have as much time as possible for Q&A at the end of today's panelist presentations. So today's topic is what investors want, how to scale up demand for U.S. clean energy and green bonds. This webinar is being brought to you by the Clean Energy Group, and it's going to feature speakers from both Clean Energy Group and the Croatan Institute. So you can see on our opening slide, our guest speakers are Rob Sanders and Joshua Humphreys. So just to get going here, a quick housekeeping slide. All of our participants today will be in listen-only mode, so we will not be able to hear you. If you have access to headset or speakers on your computer, I suggest you use that as your audio mode. You can, of course, use the telephone, and if you do use your telephone, please enter the PIN number shown on the audio mode box here into your telephone. We're going to ask that all of our questions be submitted today via this question box that you'll see on your webinar console. Type your questions into the question box, and we will queue them up and we'll pose your question as time allows following the presentations. So please do submit your questions as they occur to you. Don't hold them to the end. If you have a question, type it on up and hit send, and hopefully we'll get to your question before we have to end the broadcast at 2 o'clock today. Just so you all know, this broadcast is being recorded and it will be made available on the Clean Energy Group website. Our URL is there at the right-hand corner of your screen, so you will be able to review this broadcast at a later time or have some colleagues take a look at it if they're interested. So quickly, moving on. Today, as I mentioned, this webinar is being brought to you by the Clean Energy Group. Clean Energy Group is a leading national nonprofit advocacy organization working on innovative technology, finance, and policy programs in the U.S. on clean energy and climate change issues. Clean Energy Group also manages the Clean Energy States Alliance, which is a coalition of state and municipal clean energy funds. For more information about Clean Energy Group and our other projects, please visit www.cleanegroup.org. Today from Clean Energy Group, our guest speaker will be Robert Sanders. Rob is Senior Finance Director at Clean Energy Group. He has over 25 years of experience in community development and energy-related commercial finance with expertise in designing, implementing, and evaluating financing programs, financial products, and related services in the areas of clean energy and sustainable community development. Rob was formerly the Managing Director of Energy Finance for the Reinvestment Fund, a leading innovator in financing of neighborhood and economic revitalization with $700 million under management from 800 investors. In this capacity, he served as fund manager for the Sustainable Development Fund, a $32 million fund created by the Pennsylvania PUC to promote renewable energy and energy efficiency. Rob has served 2 terms on the board of the Pennsylvania Energy Development Authority and was a director and officer of the Clean Energy States Alliance. Mr. Sanders, or Rob as we affectionately refer to him as, also holds an MCP from the University of California at Berkeley and a BA from Stanford University. So Rob, thanks for joining us today. Also co-hosting this event is the Croatan Institute. Croatan is an independent nonprofit institute for advanced social and environmental research and engagement. The Institute's activities address some of the most complex sustainability challenges of our time, often in close partnership with practitioners in the field and movements for social and environmental change. For more information on Croatan, please visit their website, and their URL is posted up there on the screen. And from Croatan today we have Dr. Joshua Humphreys. Josh is President and Senior Fellow of Croatan Institute and a leading authority on sustainable investing. Josh has advised numerous organizations on complex issues in social and environmental finance. His insights on trends in sustainability, fossil fuel divestment, endowment management, and social and environmental finance and impact investing have been widely published and regularly cited in the press. He frequently speaks to the public on these themes and has served as an expert witness in both litigation and legislative arenas. He serves as an associate fellow at TELUS Institute and an advisory board member of the Dwight Hall SRI Fund at Yale University, the Responsible Endowments Coalition, and the Coalition for Responsible Investment at Harvard. So Josh, thank you so much for joining us today. So with that, and just a reminder for those who have just logged on, we do have a hard stop at 2 o'clock, so we're hoping that you will type in your questions and submit them via the question box as the webinar proceeds. Don't hold your questions to the end. Please type them in, hit send, and then we will ask your questions as time allows at the end of today's presentation. So with that, Rob, please go ahead.
Thanks, Maria. Let me get back to where I want to be. We're talking today, Josh and I are talking today about a report that was published in December, What Investors Want, which is intended to be a blueprint for action to increase the use of bonds to finance clean energy, based on an investigation of demand criteria, demand characteristics of institutional investors in this area of clean energy and green bonds. There's a link to that paper for those who have not already seen it. We would like to thank our funders who have supported this work: J.P. Morgan Chase Foundation, Tilia Fund, the Kresge Foundation, and Surdna Foundation. What we're going to do today is talk a little bit about our clean energy finance work at the Clean Energy Group, but also then get into the observations on the green bond market and the place of clean energy investment within the growing bond space. We'll summarize some findings from the report and our investigation into investor demand for green bonds. We'll especially take a look at categories of investors and specific demand criteria that are important to investors when evaluating bonds. Then there'll be recommendations for future action and some next steps. And then finally, your questions. So Josh and I will be batting this back and forth between us, and we'll get started. The Clean Energy Group works with public funds, private investors, and other market participants to implement public finance mechanisms to greatly scale clean energy. And we've written a lot about clean energy finance. The two bond papers I think are linked here and may be of interest. One is Reduced Risk, Increased Clean Energy, which looks at the role of credit enhancement in particular as a way of increasing the supply of clean energy bonds and meeting investors' requirements. Also a second paper on clean energy finance through the bond market, which is a joint paper that was published with the Brookings Institution. Our inquiry into investor demand focused on the supply side in the first year, and what we mean by that is we were looking at what are the best models of bond financing and credit enhancement that would be useful in replicating bonds for clean energy, particularly looking at domestic municipal bonds and project bonds. This past year, the focus has been on investor demand characteristics, and I think we found that there's a great deal to learn from institutional investors that will help project developers, bond issuers, and public policy to scale up clean energy investment. So with that, Josh, I'll hand it over to you.
Thanks very much, Rob. I appreciate it. Thanks, everyone, for being here today as we discuss in further detail the findings of this important research that we've done over the last year. So Rob didn't say too much about the actual process, so I'll describe it a little bit. And I also, before getting into too much detail, I simply wanted to acknowledge and thank my colleague David Roswell, who served as co-author with Rob and me on this paper, as well as two of my other colleagues here at Croatan Institute, fellow Fern Jones, and our associate Kyle Anda, who made valuable contributions to the research, outreach, interviews, and analysis during the project over the last year. So I simply wanted to acknowledge their involvement and give my thanks to them for it. In essence, what we did over the course of the last year leading up to this paper was to do research with about 3 dozen and interviews with about 3 dozen bond buyers that are active in this space, the clean energy space and the green bond space. we published a preliminary version of our paper ahead of the climate summit that happened in September in New York, and we held a side event there with a group of about 24 investors and stakeholders at the Certain Foundation, actually, that helped to inform the last phase of our research and analysis that led to the actual paper that we're discussing today. So I simply wanted to begin with a bird's eye view of the space. Green bonds they've really become a pretty exciting corner of the capital markets for those of us who care about climate change, renewables, as well as social and environmental investing writ large. And it's a really rapidly growing space. At the time when we published in early December, we didn't have finalized figures for 2014, but the new issuance of green bonds were on pace to really exceed in one single calendar year the entire issuance that had ever been tracked over the last 2 decades, basically. Many folks were anticipating that the space might come out at about a $40 billion space. It was a little lower by end of calendar year. The latest data that I've seen tracks the space at about $36.6 billion in 73 issuances. That's about triple over 2013. And again, it's nearly the same amount as the combined $38 billion in green bond issuance that Bloomberg New Energy Finance has tracked since 1995. So it's an exploding market, even though it remains relatively small scale. What's really interesting about the space is the attention that's really been preeminently paid to the international market. Many people understand the green bond market as primarily a supranational and sovereign debt market, in part because some of the first labeled green bonds and climate-related bonds came out of the European Investment Bank and the World Bank and out of other development banks working abroad. Some of those were first issued in 2007, 2008. So much of the conversation that investors participate in related to green bonds tends to focus on these really high-quality, often AAA-rated securities that come out of the development banking world. But what we found useful in this inquiry is the simple reminder that, in fact, green bonds have been issued for much longer, as the Bloomberg data, to which I've already referred, highlights. And we wanted to redirect attention to what we think is a far less intensively analyzed market, and that's the U.S. market. I mean, obviously, the U.S. market has a lot of challenges and opportunities related to climate finance and clean energy finance, huge obstacles that need to be overcome. So there's this longer tradition that may not be labeled as green bonds, but many people who are active in the clean energy finance market have been very actively following this space, tracking it, quantifying it, trading it, buying the bonds based on the use of proceeds. So we wanted to recontextualize this space and try to understand more fully what investors really want. What are the characteristics of demand that you see among leading bond buyers of U.S. paper in particular. We focus primarily on the U.S. muni bond market in this paper, but it also includes corporate debt as well as project bonds. When we actually look at the market, they range from very large municipal bond issuances, for example, from the Commonwealth of Massachusetts, which actually issued its first green bonds back in 2013, and as part of a general obligation series of bond issuances. And what was fascinating to observe is that the green bond series of the broader offering was oversubscribed, even though the non-green tranches of the offering in 2013 were actually undersubscribed. So Massachusetts came back to the market this year, anticipated issuing about $250 million in green bonds. It was pretty clear that demand was going to be extremely strong, and so they ended up upping the issuance by about a third to $350 million and successfully sold. A lot of other states are beginning to recognize the value of that. Across the U.S. We also see a lot of corporates getting involved in the space. on this slide, you see reference to a $225 million offering that occurred from Solar City. It was not labeled as green bonds, but it was basically an asset-backed security that was basically financing assets of Solar City in the solar space. And subsequently to that, Solar City came back and actually provided a different offering of debt, of corporate bonds to retail investors at the size of about $200 million. So there's a lot of activity going on, and we see this as a really kind of fascinating space, not only because of this growth, but also because of the interest on the part of institutional investors to align their investments more fully with their mission without compromising fiduciary responsibility. I mean, these are just regular kinds of debt, in the fixed income space that can meet the needs of many institutional investors across a wide spectrum, as you're going to hear today from Rob in particular. And we think that, particularly in the context of the debates going on about fossil fuel divestment, that many participants in the space that are beginning to grapple with the question of divestment have focused primarily on public equities and basically selling off the shares of publicly traded stocks. And we think in the fixed income space there's a very, very compelling counterweight to the posture of divestment, and that's reinvestment in solutions. And so if those investors out there that are interested in taking away sort of capital from the liquid secondary markets from fossil fuel companies, we think there's an opportunity for them also to take market away from those companies by reinvesting and deploying capital into clean energy alternatives, particularly in the fixed income space. To give you a sense of the scale of this market, but also what we describe in the paper as terminological confusion around this space. This Venn diagram highlights our real interest in focusing on U.S. clean energy bonds. The large center circle that you see is basically a representation of a $500 billion global space of what has been termed the climate bonds or climate-themed bonds. And the Climate Bonds Initiative in the UK is one of the organizations that's really led the way in doing a lot of research on this space. And they have suggested that nearly $500 billion, indeed more than $500 billion of activity in the global bond markets could be in some ways supportive of some kind of climate thematic investment. This, in many ways, is sort of too big to be useful in our view. And so we really are focusing on the domestic portion of that, and for financing where the use of proceeds really are going toward energy efficiency, clean energy, generation and distribution in order to really focus. At the same time, there's a kind of green bond market, which is not just about clean energy. It includes an emphasis on any environmentally beneficial project. It could include water infrastructure, conservation of natural resources other than energy, and lots of other things that many of the green bond issuers are beginning to focus on. So again, our interest in clean energy finance is to distill out of the green bond space what is really being supportive of clean energy finance. And as you'll see in the Venn diagram, we see very little, in fact, that is directly supportive of that. And so we basically observed over the course of this inquiry a huge disequilibrium and a lot of confusion. So to be very clear, we're not talking about climate bonds today. We're not talking about the entire green bond space. We're very interested in the domestic U.S. Bond markets as they can be supportive of clean energy. So to begin to get it into some of our findings, the basic observation that we made is that demand for this kind of paper is not homogeneous across all the categories of investors. And therefore, analysts, participants in the space need to be cognizant of the diverse needs of a variety of different kinds of institutional investors that are participating in the space already and are very interested in the space. And each institution obviously has its own set of investment criteria. And again, issuers, underwriters, and participants and analysts in the space and those who are trying to improve this market need to really take those individual criteria seriously of the different kinds of institutional investors that we've analyzed. And one final basic characteristic is that sustainable and responsible investors or socially responsible investors, impact investors are clearly participating in this space very actively and have been for a long time. But what seems to be really new and interesting is that lots of non-SRI investors and asset managers are very actively participating in buying this paper as well. So in many ways, the oversubscription of many of the issuances that have appeared over the last few years can be understood as a form of additionality on the demand side, that you have traditional forms of SRI-type investors participating in the space, but increasing numbers of mainstream investors and conventional asset managers are participating not because of the green attributes per se, but simply as part of their approach to fixed income investing writ large. In this particular study, our focus tended to concentrate on different kinds of bond buyers that we saw active in the market. We reached out to a group of asset managers and investment consultants that vet managers. These include both SRI and non-SRI and conventional asset managers, foundations and endowments, particularly foundations, even more so than college endowments, many of whom are grappling with fossil fuel divestment. Faith-based investors were another important group that we reached out to and that we identified as being active in the space. Investment banks, obviously as underwriters, play a really critical role that Rob will speak to in a moment, but also as bond buyers for their own books of business, we found really quite actively. Corporations and insurers also are very active in this space, and finally public pensions. And with that, I'm going to turn the controls back over to Rob to give you a deeper sense of the demand characteristics of these different kinds of institutional investors.
Great, thanks, Josh. Well, let me say a few things about each category of investor that Josh mentioned, beginning with conventional or mainstream asset managers and investment consultants who have a preference for high-quality green bonds with clear performance benchmarks. They need to look at these investments and see how they perform as compared to other assets they're purchasing in their various classifications and allocations. Securities for these investors will generally require a credit rating or strong credit enhancement in order for them to buy these securities. SRI asset managers, socially responsible investments, often are more concerned with a transparent use of proceeds than whether they're labeled green or not. So they pay particular attention to the use of proceeds and getting comfortable that a green bond does what it says it's going to be doing. SRI managers expect equal financial performance from green bonds as from other bonds that they hold. This is going to be a theme that recurs in each investor group, but it's true of SRI asset managers as well. These investors manage money for a broad range of clients, whether they're high net worth individuals or tax-exempt foundations and endowments. So they want both taxable and tax-exempt bonds. I'll say another word about divest, invest philanthropy. Josh already has mentioned this, but there's a growing group of foundations that is committed to both divesting from fossil fuel securities and also investing in clean energy and other climate solutions. This I'm talking now about foundations and endowments.
Hang on just a second, Rob. Let me get to the correct slide here for you. I think this is where you want to be right now.
Okay. Yeah, I'm talking now about foundations and endowments. In the past, the reinvestment part of that equation has focused on clean tech private equity and venture capital. Increasingly, there's an interest in green fixed income securities. We also found that foundations who buy green bonds are unwilling to sacrifice returns. Yield is as important to them as anyone else. We found that faith-based investors have a strong interest in environmental issues, but they are generally focused more on social issues. So some of the investors said that they would buy more green bonds if there were a social dimension to the use of proceeds for the involved in those bonds. For instance, if clean energy measures in affordable housing and community facilities projects were part of the use of proceeds. Some faith-based investors also said that their guidelines allow for lower grade and some unrated paper, so more flexibility with some of the faith-based investors in that regard. These investors also were interested in a wide range of sizes of issuances, including small bond issuances, which is not true of all institutional investors. Investment banks will underwrite green bonds to hold for their own account, as well as to sell into public markets or as private placements. Big banks are focused on larger deals and less so on small muni project bonds. I want to single out a number of major banks include JP Morgan Chase, Bank of America Merrill Lynch, and Citigroup, who were leaders in creating the green bond principles. And there's a link to those principles for those who are not familiar with them or want to take a look at them again. These principles provide a framework and process for evaluating the environmental impact of green bonds. They don't define what a green bond is, and they don't certify anything, but they have an approach, a framework for understanding, for evaluating the impact, the environmental impact of those bonds. We think these principles are very helpful in moving the market towards standard disclosures for green bonds, which is something that a lot of investors are now requesting. So corporations and insurers. Insurance companies seek investments across all fixed income markets. That includes municipal bonds, government bonds, corporate bonds, at all tenors, all durations, across the entire credit spectrum. For instance, Zurich Insurance recently announced it will double its allocation to green bonds from $1 billion to $2 billion. Many of the largest corporations have bought green bonds for their treasurers' operating portfolios, as well as to implement their company's sustainability and corporate social responsibility strategies. Now, we also looked at specific demand criteria that are important to institutional investors when evaluating green and clean energy bonds. First, though, here's some general observations. Investors who are buying green bonds want to see more of them in the market. There's a strong sense that the more of these investments the easier it is for them to continue to invest, whether that's liquidity or other reasons. There's a desire, a demand to see more green bonds from those who are already buying them. Tax-exempt investors, such as pension funds and faith-based investors, have little interest in most muni funds, as one would guess, because the great majority of municipal bonds are tax-exempt. There are taxable muni bonds, but they're a small subset of municipal bonds in general in the United States. We found there are significant problems with insufficient aggregation and non-standardized structures and terms. Because size matters, you need to bundle and aggregate enough underlying transactions, whether those are small commercial or consumer loans or project financings, into a sufficiently sized and homogeneous security that it'll attract an investor. At least the credit has to be determined by the portfolio and the credit enhancement. So insufficient aggregation is a problem. Non-standardized structures and terms, same thing. It's an impediment to being able to assemble a security if the structures underlying the bond issuance are not similar, and if the bond issue itself doesn't look like other bond issues that buyers are buying. So a number of investors said these bonds need to become plain vanilla, and that was a clear message. So let me touch on some specific demand criteria that are important to investors. First is liquidity, which is the ability to sell or buy securities easily without a big change in price at the time that you need to sell it. This is probably one of the most important demand characteristics across all categories of investors. And it is essential for funds that require daily pricing and redemptions, such as bond buyers and asset managers for mutual funds, which need to mark to market each day. Credit quality. Investors have a wide range of credit requirements. We found that some want bonds across the entire credit continuum, from unrated paper to low investment grade paper to high quality AAA bonds. Some want only high credit bonds, want it to be comparable to Treasury securities or government agencies. Others only lower quality and high yielding papers. So quite a range. And as I said, size matters. Now, SRI asset managers and foundations and endowments may have more flexibility here. They expressed an interest in considering smaller bond issuances. Large investment banks and institutional investors are looking for as many index-eligible bonds as possible in this area. They don't require that, but they're looking for that, which are agency-rated securities, minimum of $100 to $200 million to qualify for indexes. Some investors said that concerns regarding size could be mitigated by quality insurers, good insurers, issuers, I should say, building reliable pipelines of standardized, well-structured bonds, even if each bond is relatively small. So there is an interest in doing in purchasing small bonds, but it's only if it's made easier to do so if they know that there's a quality issuer is going to be coming through with similarly structured, similar quality bonds in this space, and so they don't have to relearn or learn a new structure the next time. Terms. Clean energy and green bonds need to be priced similarly to other bonds. Again, the investors are not willing to pay a green premium for clean energy bonds or green bonds. Use of proceeds. For some investors, transparency of use of proceeds was a central concern. They called for additional disclosures. That's clearly an advantage for clean energy project bonds, where the use of proceeds is dedicated to clean energy or other projects. It's more problematic sometimes in general obligation bonds by municipalities or states that finance a broad range of projects, infrastructure projects, and where it may not always be as clear what the environmental impact might be. For other investors, if they like the credit and yield, they'll buy it. They're not particularly concerned with additional disclosures regarding the environmental use of proceeds, but they are concerned about risk and yield. And finally, labeling. Some investors want more information to assess whether a bond meets their green criteria. And other investors suggested that all clean energy bonds be explicitly labeled as green bonds to integrate them into what is becoming a distinctive category of the bond market. So not to leave that demand or interest in green bonds on the table when it comes to clean energy bonds, but that they should participate and enjoy that distinction as well. Okay, well that's a quick dive into the paper's findings. I'd like to hand it back now to Josh.
Great. Thanks very much, Rob. So to wrap up here, we'd like to turn to the basic recommendations of the paper. We view this inquiry as an important first effort at understanding the demand characteristics of institutional investors in this market, particularly in the United States. And we really wrote the paper increasingly over the course of the year, not just as inquiry, but also as a blueprint for improving the disequilibrium that we found in the market to enhance the market further. And we have three broad clusters of recommendations that we make, and I'd encourage those of you who are more action-oriented and interested in our findings and potential next steps to take, to actually go to the paper where there are actually much fuller elaborations of these recommendations. So the first cluster of recommendations focus on additional research and analysis that we think really needs to occur. This involves a variety of different possibilities. One thing that we didn't do by focusing on such a narrow subset of bond buyers in this kind of high-touch research way that we did is that we didn't have the opportunity really to try to size the market. We did some very exploratory back-of-the-envelope calculations, but I think much more needs to happen there, and it would be reassuring, I think, to issuers to understand more fully not only the nature of the demand, but also the scale of it. We think that a lot more research also needs to occur, though, among other kinds of bond buyers that we didn't have quite enough bandwidth to consult as adequately as we could, particularly among asset managers. A lot of asset managers are beginning to create product around green bond type themes or sustainable investing themes in the fixed income space. We really only scratched the surface there. We think a lot more outreach could occur among certain kinds of institutional investors as well. The growing number of foundations and other investors that are embracing fossil fuel divestment, it would be very useful for us to have a deeper understanding of their interest and their appetite for these kinds of instruments, as well as pension funds more broadly that obviously have some of the largest pools of assets in the United States and the most interest in potentially supporting some of these efforts. We also think that greater consensus could probably emerge about the nature of this instrument through greater research on the green bond attributes. Basically, there is a kind of debate that's emerging, particularly with the interest on the part of index providers. S&P, MSCI, and others are beginning to actually create green bond indices, even with the relatively limited supply that we've seen historically. The construction of these indices raises questions about, the nature of this instrument as an asset class. And I think much more work can be done around those kinds of questions, or whether there's simply, specific kinds of debt instruments within the fixed income asset class. I do think a lot more work could be done with the underwriters in particular in order to understand why many underwriters, despite Rob's comments about some of the largest investment banks' real interest and leadership in this space, there are many kind of mid-market investment banks that work with many smaller muni bond issuers who really haven't adopted any of this whatsoever. And to find out why that is, I think much more work could be done there in particular. And then finally, we're also really intrigued by potential connections between the green bond space and instruments that are regularly used by nonprofit institutions like colleges and universities or hospitals, as well as municipalities such as green revolving loan funds to support energy efficiency and other kinds of innovations within their facilities. The second cluster of recommendations focus on convening and collaboration. We held this one-site event at the Climate Summit with a very heterogeneous group of bond buyers that were relatively representative of the cross-section that you see in our study, as well as other stakeholders such as credit rating agencies, some of the investment banks, and some nonprofits and stakeholders, as well as philanthropic foundations that are very interested in the space, both as investors and funders. We think that a concerted effort to have more tailored convenings among like-minded bond buyers who operate under similar kinds of fiduciary constraints would be extremely useful. So less heterogeneous, much more homogeneous groups of investors, groups of foundations, groups of pensions, groups of faith-based investors, groups of asset managers, where you can really dive deeply into conversations about what they need, how they'd like to see this market improve, I think would be extremely valuable. We also think, in particular, as we've already alluded to, that the fossil fuel divestment space in general is a group of institutional investors that's growing very, very rapidly and should be convened in different ways to explore the relevance of green bonds as a fixed income instrument within their approach to reinvesting around climate solutions and the new energy transition that our planet desperately needs. Finally, the most action-oriented cluster of recommendations is really around the deal flow within the space. Our analysis suggests that there's a huge mismatch between investor demand and current supply. What we see in the market is really highly tilted to high-quality, generally short-tenured issuances. And we increasingly heard that investors are reaching for yield. They'd like to see a greater diversity of paper out there. In order to develop and diversify and deepen the deal flow, we think we need to understand more fully the models that have worked successfully. And we've identified several of them. We've both spoken to a few of them, like the Massachusetts Green Bond, which has been oversubscribed very successfully, Solar Cities model, which has done quite well, but also a series of others that we describe, including sort of the deal of the year in 2013 that was issued by NYSERDA, the New York State Energy Research and Development Agency. It was a relatively small issuance, but one that was involving taxable debt and credit enhancements and really innovative ways that actually hadn't been done in the past. We analyze it in considerable detail in the paper and suggest that there's a lot of tax credit money out there that's being left on the table that really couldn't be much more aggressively mobilized to support the space. We think there needs to be, deeper and more diversified pipeline of specifically clean energy bonds within the green bond space that do have longer dated tenors, that are larger issuances that might be structured in a way that bundles smaller issuances that are kind of moving under the radar screen, that are not eligible for indices because of their scale, their low scale. And also, as Rob suggested in his discussion of particular kinds of institutional investors, that would meet those expectations. You heard him describe how faith-based investors are really more interested in the social dimension. The environmental piece is actually kind of more of a bonus. But there are mandates to do affordable housing investing and things like that. And we think green bonds could be innovatively deployed to tap into some of that, particularly for faith-based investors that are grappling with fossil fuel divestment, as so many of them are. And then finally, we simply would like to see the green bond space get more serious about funding climate solutions and funding clean energy in particular, and to, in essence, deepen the clean energy attributes of green bonds. We think clean energy finance on the fixed income side needs to embrace the green bond market and the labeling that's happening. So we really want to encourage that and that exploration. Historically, a lot of this paper has not been labeled as such, and we think because of that, it's remaining relatively niche. So there's a huge opportunity to call this kind of paper that does support clean energy or energy efficiency, to call it green debt, and to get in front of the investors that clearly have a real strong interest in it. To conclude, in essence, as many of you may know, bonds are pretty staid. They're understood as some of the most conservative instruments in the capital markets. But what's happening in the bond market right now is extremely exciting. And the structure of this debt and the opportunities to structure in very tailored ways to identify specific kinds of projects that are being financed, very exciting. And I think a lot more needs to happen in this space. So with this paper, we are also issuing an invitation to partners and funders to join us in working on this blueprint. We think a lot of work needs to happen. In the short term, our hope is to engage more deeply with the divest invest space around these kinds of themes. We do, in particular, think foundations and endowments have an important role to play, and we're looking for opportunities to convene those groups to have even deeper conversations with them. We've described, many of the needs, and we want to continue to test these kinds of working hypotheses with investors who are really active in the market. So with that invitation, I'd like to thank everybody for their time. We look forward to your questions, and we do hope that you'll have the opportunity to reach out after the webinar if you're interested in this work to see if you might be able to partner or collaborate with us or to support it through funding. So thanks very much.
Great, that's excellent, Josh and Rob. Thanks so much for those that overview of the report. We have a number of questions that have come in, and so if you just give me a minute, I'll start running through the list, and hopefully we'll get through quite a few of them. Just so everyone knows that off the bat, this presentation is being recorded, and we will post the recording and the slides up on the Clean Energy Group website, and you'll see the URL there. First question is, are there any third parties who rate or certify issuers and bonds that are generally perceived to be valid and reputable?
This is Josh. Quickly, yes, there are several. They tend to be in Europe, even those that are rating or certifying the basically compliance with the green bonds principles. The firm Vigeo in France, Cicero in Norway. Our understanding is the big four accounting firms are looking closely at this as well.
I think the point here is that it's less a certification of whether they qualify as a green bond as opinions. They're done as third-party opinions that raise questions or comment on the strengths on an environmental basis. But I think there's a reluctance at this point in the market to be too rigid in saying that this is a green bond as opposed to that. That may happen in time, but at this point it's a growing market.
Great. Thanks, Rob and Josh. The next question is, will there be problems in finding support for energy projects using technologies such as compressed air and air energy storage that are perceived as new or involve projects costing over $1 billion, and that's billion with a B?
As far as new technologies, it's always an issue in financing. I mean, if it is a question regarding new technologies, that's always going to be an issue in getting financing. So if there's an interest in supporting new technologies, often that needs to be done under some sort of strong credit, whether it's a corporate bond or where somebody is trying to develop that technology, or under a general obligation bond where there's a special interest in that.
Okay. Our next question is, when you were doing the interviews, were the investors already quite knowledgeable about climate science and about the IPCC's decarbonizing time frame?
I would say it varied greatly among the investors. We were obviously talking to sustainable and responsible investors as well as very conventional investors. Climate science wasn't sort of part of the script, so to speak, for our interviews, but it was pretty clear that there was a very strong sense of urgency among those people who have been dedicated to this space for quite a long time. Rob, I don't know if you want to say anything more. We interviewed a few mid-market investment banks who really had little understanding of this market. I don't think we really got into whether climate skepticism informed some of that.
You know, some institutional investors don't even track it, don't even know whether they have green bonds. They assume they do, but that's not the important thing. The important thing is the yield and credit and whether it meets an allocated classification that they need to fill. And so a lot of people are leaving that on the table, that perhaps goodwill that might be associated with doing green bonds.
Okay, thanks, Rob. And Josh, our next question is, do you find acceptance of PACE bonds from state or local offerings, I guess? So acceptance of PACE bonds.
There have been. There was recently a successful bond issuance from Connecticut, CEFIA's Connecticut Green Bank issuance involving PACE bonds. So they're perceived as being fairly secure because it has a super priority lien based upon the ability to do a tax lien if there a judgment against the property if for payment. So there was a successful recent bond issuance there.
Okay, thanks. Next question. This one's to you, Josh. You had mentioned, you had said disequilibrium in the market, and when you started your conclusions part, or maybe it was the part before that. Can you kind of explain what you meant by disequilibrium in the market that this research found?
Sure. I mean, basically, it's just the supply-demand mismatch that we see when you've got massive oversubscriptions of what exists. There's clearly demand that's not being met, and particularly when it comes to the lower quality debt, there was clearly a hunger for much diversified forms of issuance at lower credit qualities and longer tenors. That's just not being provided by the current market, and so that's what we're trying to identify as a huge opportunity for issuers and a real desire on the part of investors to reach for more yield and to have a diverse array of opportunities. And even among those who focus on the high credit quality, they have a real interest in doing more deals in the U.S. And not just relying on supranational debt.
Excellent, thanks. Our next question is, do either of you have suggestions for the best path to market with green bonds? Traditional banks, underwriters, or direct to SRI investors via PPMs with asset managers, or other suggestions? So the best path to market with green bonds.
Well, there are a number of ways. You know, I think one way that the simplest way is to include green and clean energy use of proceeds in bonds that are already that typically are happening, whether those are school bonds or general obligation bonds of other sorts. I think there's a large opportunity for continued clean energy municipal bonds, muni bonds, and I think we've had some friction, some stickiness in being able to get to use all the qualified energy conservation bonds that are available right now, and part of that is just how that program is structured with. That there's so many small allocations between municipalities and states that it's hard to aggregate enough allocation to make a meaningful bond issuance. But I don't know, Josh, do you have ideas about that as well?
I would echo you, Rob. Actually, I don't think there's one silver bullet here. If anything, that's what came out of our study. Is there are a variety of really interesting models that have emerged. We need to study those models, and we need to replicate what works best. And if there's any best path to making this work better, I would say it would be more on the public side, not to trade quietly to order, as often happens, especially among insurers and corporates, and to some extent what's happening in parts of the SRI space, but instead to bundle what exists, to take full advantage of the tax credit money that's being left on the table, has been for years within states, and to try to do it at a larger scale to attract the attention of these investors that cannot find enough paper to buy.
Okay, that's good. Here's a question for you. What are the current yields for taxable green bonds?
Depends on it depends on the issuance and the market and the obligor. So it's really hard to generalize. It's obviously a moving target. Interest rates are very low. It's a challenging time in the fixed income market, but at the same time, equities are looking really volatile right now, and so you're obviously starting to see that reflect in the market. It's kind of a moving target. I don't know, Rob, if you want to say more, but it's hard to just answer in a kind of curt way.
Yeah, it really is. Corporate bonds. It all depends on the strength of the obligor, as you say, Josh. And then, of course, tax-exempt rates are going to be different from taxable. So it's hard to say.
Okay. Our next question is, do you know of the Coalition for Green Capital? And if so, what role would you see them play as it is working in developing state-level green banks? I guess you could also address what role state-level green banks would have in this market.
Coalition Green Capital is working to develop additional financing capacity at the state levels with green banks, and we commend them for that. And I think one opportunity would be that there's a need for being intentional and programmatic about aggregating pipelines of transactions, finance transactions, and to then hold them in some sort of short-term warehouse credit facility, let's call it that, for for a short term, 1 year, 2 year, whatever it would be, as you roll up a sufficient number of transactions in order to bundle into a security. I'd like to see green banks do that and try to identify those pipelines of projects that would do that. There are large community development financial institutions, national CDFIs, which are building pipelines of long-term finance transactions, and many of those are beginning to use clean energy efficiency as their project use of proceeds, and so I think that's an opportunity for green banks.
Okay, and see if we can have just a couple more questions here before we'll have to wrap up. The next one is, do you think the uncertainty of renewal of the tax equity incentive on solar projects expiring in 2016 will have a big impact on clean energy projects and the growth of green bonds?
My feeling is that the industry has been preparing for this eventuality for some time, and it will not have a major impact. I mean, certain projects won't get done, but I think there will be a lot of transactions financed through bonds.
Okay, the next question. A considerable number of projects in energy efficiency and renewable energy have longer paybacks of 12, 15, or even 20 years. Consequently, the financing against these projects needs to be longer. Did your study explore the desire of investors to put money into longer dated investments, say 12, 15, or even up to 20 years, as opposed to the shorter dated paper more commonly found in the market today?
Yes, there was really interest in that, and that's what's wonderful about the structuring characteristics of the green bonds and clean energy bonds, is that they really can be tailored to these longer-term infrastructure projects. I mean, that's why debt is often used in this way, and although it wasn't a clean energy bond, one of the biggest green bonds that kind of made waves this year was Washington, D.C.'s Water Authority issued the first century bond, 100-year bond for a water infrastructure project, and again was very successfully subscribed in the market. So there's definitely a desire for longer tenured paper with the yield and risk characteristics priced accordingly.
Great. With that, I think what I'm going to do is start to close out the webinar here, and to give both Rob and Josh an opportunity to make any closing comments or to make any observations that you wish you had discussed before that you didn't have a chance to. Josh?
Again, I'm simply eager to continue this work. We're hopeful that we can extend our analysis and continue to do outreach. Obviously, it's a a really fast-growing growing space alongside the very rapidly growing fossil fuel divestment space. There's a meeting of the minds that really needs to happen, I think, on the investment side. We're very interested in exploring that with investors, with partners, with stakeholders, with funders.
Great. And Rob, any last comments?
Only to say that very much interested in trying to figure out ways to roll up and aggregate more transactions that have standardized terms, and so we have a particular interest in this warehouse credit facility idea, and seeing if there can be an opportunity to begin to bundle systematically and more reliably securities for purchase.
Excellent. Well, thank you both, Josh Humphreys and Robert Sanders, for being giving us some excellent presentations today. And that's going to conclude today's webinar. Again, this will be posted up as a webinar recording on the Clean Energy Group website, and also the slides will be available to you there. And feel free, if you have any follow-up questions, to contact our guest speakers, and their contact information is there on your screen. So thank you all for attending today. We look forward to your participation in an upcoming webinar, and this concludes today's event. Have a great day.